Every morning at 11 o'clock, in a London office, one number was published. It set the interest rate on $350 trillion of financial contracts, home mortgages, corporate loans, student debt, credit cards, derivatives. 16 banks submitted a rate. The top 4 submissions were discarded. The bottom 4 were discarded. The middle 8 were averaged. That was the number. It was called LIBOR, the London Interbank Offered Rate. For at least 15 years, it was rigged. On the 27th of June 2012, 1 month before Bruno Iksil and JPMorgan admitted the London whale loss, Barclays admitted to rigging LIBOR and paid $450 million in fines. 6 days later, the chief executive of Barclays resigned. 12 years after that resignation, the only trader ever convicted by a jury for LIBOR rigging walked free from prison. The number he had gone to prison for setting no longer existed. LIBOR, Barclays, 2012. LIBOR was invented in 1969 by a Greek banker named Minos Zombanakis. He was arranging an $80 million loan to the Shah of Iran and needed a floating rate benchmark. He asked 6 London banks to submit their cost of funds every morning. The average became the reference rate for the loan. The idea spread. By 1986, the British Bankers Association had formalized it. By 2007, LIBOR was published in 10 currencies across 15 maturities. The most important, 3-month US dollar LIBOR, was referenced in $350 trillion of financial contracts around the world. The mechanism was simple. Every business day at 11 o'clock London time, 16 banks on the US dollar panel submitted a rate. The rate answered a single question. At what interest rate could this bank borrow unsecured, in reasonable market size, in the London interbank market? The submissions were reported to Thomson Reuters. The top 4 were discarded. The bottom 4 were discarded. The middle 8 were averaged. The result was published 30 minutes later. That mathematics meant something important. To move the published rate, you did not need a majority of the panel. You needed only 2 or 3 submitters to agree. To understand why LIBOR was rigged, you have to understand what a basis point does inside a trading book. An interest rate swap is an agreement between 2 parties to exchange interest payments on a notional amount. One side pays a fixed rate, the other pays a floating rate. The floating rate is LIBOR. On a $10 billion notional swap book, a 1 basis point move in LIBOR, 1/100th of 1%, was worth roughly $1 million per day. Tom Hayes was a yen rate derivatives trader at UBS's Tokyo desk. By 2007, his book had grown to $50 billion in notional exposure. A 1 basis point favorable move in yen LIBOR for a single day meant $5 million added to his profit and loss. Hayes was on the panel of banks that submitted yen LIBOR. He knew the submitters at UBS. He knew the submitters at other panel banks, Deutsche Bank, RBS, HSBC, Citigroup, Rabobank, because he traded swaps with them every day. So Hayes began asking, emails, Bloomberg chats, any chance you could set 3-month a basis point higher today? I owe you big time. The submitters at UBS moved. The submitters at other banks moved. A basis point here, a basis point there. Over 4 years, small manipulations added up to hundreds of millions of dollars in profit. But that was only half the crime. In August 2007, the interbank lending market seized. Banks stopped trusting each other. Overnight funding rates spiked. Term funding, 3 months, 6 months, became almost impossible for weaker banks to secure. This created a new problem for the LIBOR panel. A LIBOR submission was public. If a bank submitted a high rate, it was saying to the world, I can only borrow expensively, I am distressed. Every submitter on the LIBOR panel now had an incentive to submit a rate below what the bank was actually paying, to lowball, to reassure the market and their own regulators that the bank was healthy. Barclays did it, UBS did it, Deutsche Bank did it, Citigroup did it, every panel bank did it. Through late 2007 and into 2008, published US dollar LIBOR was systematically lower than the rates banks were paying for actual funds. The Bank for International Settlements later estimated the gap at 15 to 20 basis points at the peak, 15 to 20 basis points on $350 trillion of contracts. It took another 4 years for anyone outside the banks to force the truth into daylight. On the 29th of October 2008, 6 weeks after Lehman Brothers failed, Paul Tucker, Deputy Governor of the Bank of England, telephoned Bob Diamond, Chief Executive of Barclays Capital. The conversation, as later summarized in a Barclays internal file note, ran roughly as follows. Tucker said that senior figures in Whitehall had noted Barclays' LIBOR submissions were consistently among the highest on the panel. He said the submissions did not always need to be the case that we appeared as high as we have recently. Diamond wrote up the call and forwarded it to Jerry Delmessier, his chief operating officer. Delmessier read the file note as an instruction from the Bank of England to lower Barclays' LIBOR submissions. He passed the instruction down to the Barclays cash desk. The submissions came in lower the next morning, and the morning after, and every morning for months. When the truth surfaced 4 years later, Tucker would testify, under oath in front of the Treasury Select Committee, that he had never given such an instruction, that Delmessier had misinterpreted. The email chain, however, was in writing, and it would be the document that ended Bob Diamond's career. On the 16th of April 2008, the Wall Street Journal ran a front-page article by a reporter named Carrick Mollenkamp. The headline read, "Study casts doubt on key rate." Mollenkamp had done something obvious that no one else had bothered to do. He compared the LIBOR submissions of individual banks to what those same banks were paying in the credit default swap market, where the price of insurance against a bank's default reflected the market's real view of that bank's borrowing cost. The gap was systematic. Every LIBOR submission was materially lower than the market-implied borrowing rate. Every bank, every day. The industry response was to attack the methodology. The BBA said no action was needed. LIBOR submissions, they said, were indicative. In April 2009, the Commodity Futures Trading Commission, under Chairman Gary Gensler, opened a formal investigation. The Department of Justice joined. The Financial Services Authority in London joined. The European Commission joined. Investigators subpoenaed 6,000 documents. They read 3 years of trader emails and Bloomberg chat transcripts. The messages were so incriminating that they read like satire. "Dude, I owe you big time. Come over one day after work and I'm opening a bottle of Bollinger. Each one an admission." On the 27th of June 2012, Barclays admitted the rigging. $200 million to the CFTC, $160 million to the Department of Justice, £59.5 million to the FSA, roughly $450 million total. The bank's share price fell 15% by the end of the week. Marcus Agius, the chairman, resigned on the 2nd of July. Bob Diamond resigned on the 3rd of July, 6 days after the settlement was announced. Diamond appeared before the Treasury Select Committee on the 4th of July. The MPs questioned him for 3 hours. He said he had felt physically ill when he first read the emails. He said he had not known. The Barclays settlement was the first. In December 2012, UBS admitted the rigging and paid $1.5 billion. In February 2013, RBS paid $610 million. In October 2013, Rabobank paid $1 billion. In April 2015, Deutsche Bank paid $2.5 billion, the largest single LIBOR settlement in history. By 2016, industry-wide fines for LIBOR manipulation exceeded $9 billion. Every major bank on the panel had been implicated, but only one person went to prison after a jury trial. Tom Hayes was 35 when the trial began at Southwark Crown Court. The indictment ran to 8 counts of conspiracy to defraud. The evidence was his own words. Hundreds of Bloomberg chats and emails sent between 2006 and 2010, in which he had asked LIBOR submitters at UBS, Citigroup, Deutsche Bank, RBS, and other panel banks to move their rates. His defense was threefold. First, the submissions his colleagues made were within a legitimate range. LIBOR panel banks had discretion about which of several plausible rates to submit. Second, his managers knew. His managers had approved his book. Third, everyone did this. Every trader at every panel bank for years. Hayes had been diagnosed with Asperger's syndrome. The diagnosis was not disclosed to the jury. On the 3rd of August 2015, after an 8-week trial, the jury convicted Hayes on all 8 counts. Mr. Justice Cook sentenced him to 14 years in prison. On appeal, the sentence was reduced to 11. Hayes served 5.5 years. He was released on license in January 2021. His son Josh had been born 4 months before the trial began. The child was 5 years old before he saw his father outside a prison visiting room. On the 24th of July 2024, 9 years after Tom Hayes was sentenced, the UK Supreme Court unanimously quashed his conviction. The judgment, delivered by Lord Legate, held that the trial judge had misdirected the jury. A LIBOR submission, the Supreme Court ruled, could legitimately reflect a range of considerations, including the commercial interests of the submitting bank, provided the number chosen was one at which the bank could plausibly borrow. The very act for which Hayes had gone to prison, asking submitters to consider commercial interests when choosing a rate, was, the highest court in the United Kingdom now held, not a crime. On the same day, the court quashed the conviction of Carlo Palombo, a former Deutsche Bank Euribor trader who had served 4 years. While the courts were resolving the human legacy of LIBOR, the number itself was already gone. On the 30th of June 2023, US dollar LIBOR ceased publication. It was replaced in the United States by the Secured Overnight Financing Rate, SOFR, a rate calculated from the entire US Treasury repurchase agreement market, not from the guesses of 16 submitters. In the United Kingdom, SONIA. In Europe, ESTR. The number Tom Hayes had gone to prison for setting no longer existed. The number Bob Diamond had resigned over no longer existed. The number that had governed $350 trillion of the world's financial contracts for 54 years had, in the end, been abolished. Next episode, 300 years before Bob Diamond signed the Barclays settlement, 1720 London, the smartest man alive was watching a stock rise, then buying at the top, then buying again on the way down. His name was Isaac Newton. The stock was the South Sea Company. And by the end of 6 months, he had lost the equivalent of £3 million.